Now I'm going to explain mark price and last price. So on your chart, on this upper toolbar, you will see this little button here which says last price and mark price. So last price, if you select this, actually, if you just change what this is, it's just going to change the candlestick chart that you're looking at just very slightly, like very, very slightly. So when we select last price, what we're looking at is this is the price action for this specific product on this specific exchange. So what is the last traded price? What was the most recent trade that went through? What was the price of that on this specific exchange? BitUnix, right? This is what last price is. Mark price is slightly different in the sense that what the chart is showing here, this is more like of a, what is the fair price of this product, which takes a whole bunch of different calculations for how it assumes or how it calculates what is the so-called fair price of Bitcoin. Not what is the last traded price of Bitcoin on this specific exchange, but what is the fair price of Bitcoin? And the way that they do this is they would look at what is the average traded price of Bitcoin across a whole bunch of exchanges, and they will give different exchanges different weightings, right? So I can actually just go in info here and I can take a look at it. So you can see here it says index source, BitGet, Binance, and Bybit. These are the three exchanges that BitUnix is using to determine what is the fair price or the mark price of Bitcoin. Now I'm going to explain the actual use case between mark and last price and when you're supposed to, or when I would recommend for you to use mark versus last. And I've boiled it down basically to this. If you're swing trading, so if you're taking like 1 or 2 trades every month, then I would recommend for you to rely on the mark price. But if you're scalping or you're day trading, or this is like you're taking somewhere between 10 to 30 trades per month, then I would recommend for you to just use last. I'm going to explain the reasoning for why as well. So this mainly just applies whenever you're placing a stop loss, right? So let's say I want to put my stop loss, let's say I get long immediately, like right here, and my stop loss is at these lows, right? What can happen is, let's just pretend that some random guy logs in and he market sells $10 million worth of Bitcoin futures on BitUnix. So he literally creates a candle, a down move like that, just purely from his enormous order. If I was using last price, I would get stopped out. If I was using mark price, I would still be in the trade, right? So I wouldn't actually be stopped out. So if I was using mark price, I would be protected against those very random, very rare type of mispricings that happen like once a year or like once every 2 years, like very rare. And also, by the way, they're never that big. These type of exchange mispricings, I would say like at most, like literally at most, it's going to be like 0.5% or maybe like 1% wide, something like that. So very, like not outrageous, right? But it still can happen. Like, yeah, like I said, once a year or once every 2 years. So mark is going to protect you against that. But there's a downside to using mark if you're scalping or day trading on a regular basis. And that is that the mark price has a little bit of a lag to it. Meaning, let's say you took this long position and your idea was just wrong and price went down here, not because of some random mispricing, but like the price of Bitcoin on all exchanges started to drift down and then eventually it hit this price, right? The mark has a little bit of a lag to it, so your stop loss might actually execute a little bit later than normal. So instead of taking the loss somewhere down here, you might actually take the loss somewhere down here, a little bit lower. So the reason why I have mark and last set here for swing or for scalping is if you're scalping intraday, these extra losses, they massively add up, right? Like if you're taking 30 trades a month and let's say you have a 50% win rate. So 15 trades, you're losing an extra 0.1R or 0.2R. That, and like over the course of a year, that is going to massively hit you, like massively hit you. But if you're swing trading, these extra, like the costs of you paying a tiny extra fee on just like an extra 5 trades, because the frequency is low, the cost from using Mark, it's not like it doesn't compound and it doesn't add up, right? But the cost of you lose 1 trade because of an exchange mispricing out of like 300, it's not that big of a deal. It's not going to impact your P&L. But when you're swing trading, the impact of having 1 trade be a loser instead of a giant winner, this can have a huge impact to your P&L, right? So basically, we're trying to measure like, or this is how I think about it. It's a pick your poison type of situation. Would you rather pay significantly higher fees to protect 1 winning trade, like 1 giant winning trade, or would you pay would you have lower costs, but maybe like once a year, instead of winning 1 trade, you lose a trade, right? And this can actually go both ways. So you can sometimes get lucky in the opposite direction where thanks to an exchange mispricing, you actually win a trade rather than lose. But like in simple terms, I would just boil it down to this. If you're swing trading, I would recommend to use Mark. If you're scalping, just use Last. And if you're watching this video, it's very likely that you have taken fewer than a total of 300 trades in your lifetime. And if that's the case, I would strongly recommend that you actually just stick to the low time frames, really get those reps in. And then gradually in the future, you can transition to swing trading anyway, like with all of the skills that you develop on the low time frames, and then you switch over to swing trading and using Mark price. But yeah, for like 99% of the people who are watching this video, just use Last price. It makes things so much easier, and there's just less shenanigans that occur if you just stick to Last. And by the way, if you're serious about improving as a trader, I'd like to invite you into my free Telegram. Here's what you're going to get inside. You're going to get a 100-page guide on how I trade breakouts. You're also going to get a 214-page guide on how I trade reversals. And by the way, these 2 guides, I go really in depth with the strategies, with the theory, with the logic, and also I include like total combined within these 2 guides, there's more than 75 trade screenshots for you to study, like through just continuous repetition, and it's going to help you train that pattern recognition of seeing the exact same thing happen over and over again. Also, you're going to get a custom trading journal that I built, which makes it really easy for you to track your trades, but also to review your trades. Like literally in the journal, there's a tab called educational resources. And in there, I have a template for reviewing trade screenshots and guide to show you the process for how to actually review your trade screenshots to improve your performance over time. And also a whole bunch of other stuff as well that I give out for free in my Telegram. So if that sounds interesting, click the link in the description to join.